Welcome back. We are now continuing with Unit 3, the legal and regulatory framework of a fund. In this section, we're going to discuss the Income Tax Act and the implications of tax on pension funds. The difference between a pension and a provident fund are not found in the Pension Funds Act, but rather in the Income Tax Act. The Pension Fund Act merely refers to a pension fund organization when referring to a fund which includes pension, provident, and/or retirement annuity funds. However, the Income Tax Act makes specific reference to the differences. The different types of funds are discussed further in Unit 4. The Income Tax Act has specific provisions which relate to the taxation of contributions, income and benefits from pension and provident funds. The provisions in the Act provide appealing incentives for taxpayers to contribute to these funds during their working life in order to save for their retirement. For an employer of a fund member to obtain tax deductions in respect of contributions they paid into the fund, the South African Revenue Services SARS must approve the fund rules. Once the registrar has registered the fund rules, the rules will be submitted to SARS for approval. When considering the rules for approval, SARS will assess the following. There must be an employer-employee relationship. There must be compulsory and a condition of employment for the employees who fall within the definition of eligibility. It must be a bona fide fund established for the purposes of providing lump sum benefits or annuities to members and or dependents of members. Right, if we look at a practical example, many times as a financial planner, you will find that members argue against joining the employer's retirement fund. They must recognize that SARS requires that all eligible employees of the employer belong to the fund. Membership in the employer's fund is thus compulsory in terms of the Income Tax Act. The only exception is in the case of a new fund. Should you set up a new fund at the employer, all existing eligible staff will have 12 months within which to choose to join the fund, and some may never join. However, all new eligible staff employed by the employer after the inception date of the new fund will have to join the fund by virtue of this compulsory requirement. Right, so in summary, this document incorporates a revision of these laws as announced by the National Treasury on the 16th February 2016, and we'll discuss all of those more in detail a little later on. The Taxation Laws Amendment Act 2015 has passed some of the government's retirement reform proposals into law. The new rules are designed to harmonize the tax treatment of all funds of types of retirement funds, for example, pension, provident, and retirement annuity funds. The new rules will take effect on the 1st of March of 2016. In summary, from the 1st of March of 2016, the deduction cap for retirement fund contributions will increase to 27.5%. Now, for pension funds, it used to be 7.5%, provident funds 20%. Employer plus the member could have contributed to about a 20%. So this is 27.5 is a 7.5% increase above the previous levels, which is the greater of remuneration or taxable income. This rate applies to the aggregate of contributions made to individual pension, provident, and retirement funds. So it's now altogether 27.5%. Presently, different contribution caps and deduction bases apply to the three types of funds. A minimum monetary threshold of 20,000 will apply to allow low-income earners to contribute in excess of the prescribed percentages. The annual deduction cap is 350,000, including the cost of risk benefits. Individuals who contribute more in any 1 year can carry forward any unclaimed amount and deduct these from tax in subsequent years, subject to the tax deduction limits in those years. Any unclaimed contributions are returned untaxed at withdrawal or at retirement. So when you get to retirement age, when you do the retirement calculation where you've got the 500,000 exempt amount, there are certain deductions that you can also deduct according to Schedule 5 and 6, of which untaxed benefits or benefits not allowed in the past as a deduction forms one of these deductions allowed under that part of your calculation. On the employee may claim contributions both in respect of the employer and employee contributions. The employee's pay-as-you-earn deduction must be adjusted to reflect these contributions. The employer contribution must be neutralized through a fringe benefit tax levied on the employee. In the 2022-23 year of assessment, the main tax differences between a pension fund and a provident fund is that in the case of a pension fund, a maximum of 1/3 of the total retirement interest can be taken in the form of a lump sum on retirement. Still, in the case of a provident fund, the full amount can be taken as a lump sum. In the event of member's death, the Income Tax Act states that the retirement fund can provide for the entire benefit to be taken in the form of a lump sum. How will legislative changes affect employees? We'll discuss table 1, 2, and 3 a little later. We will compare the current and the revised rules for pension, provident, and RA fund members, respectively. Below, we highlight some of the general and specific issues. General issues. Both pension and provident fund members may be affected by the newly introduced annual contribution cap of 350,000. This cap includes the premiums paid with respect to cover attached to the fund, in essence, group life and disability income cover. Members who currently pay more than 350,000 by way of their and or the employer's contribution will from 1 March 2016 pay tax on the contribution above the cap and will accordingly see a reduction in their take away or take home pay. Members may benefit from the new definition on the base against which deductions is measured. This base is now higher, which is gross remuneration or taxable income. The base was previously defined as approved remuneration for pension funds and pensionable income for provident funds as defined by the employer. The reference to taxable income effectively enables pension and provident fund members who receive outside income, for example, derived from rental income, alternative employment, or from investments, to claim a pension fund deduction against such income. Previously, such outside income could only be used to claim deductions on the retirement annuity contributions. Members who wish to top up their retirement fund savings will no longer need to do so because they can do it in the fund, so they don't need to take out a separate retirement annuity. Pension fund members are least affected by these changes, as the current pension fund model is effectively becoming the standard retirement fund model. One notable change is that the minimum fund balance requiring annuitization, which means a monthly income, will increase from 75,000 to 247,500. Provident fund members will benefit from a larger tax deduction in percentage terms on contributions made to their provident fund. The effective increase is from 20% in the past to now 27.5% of gross remuneration or taxable income. Provident fund members who currently contribute to their funds will see an increase in their take-home pay, as they will now receive a tax deduction on the contributions. If we look at RA funds, RA investors are impacted positively by these changes. They will now receive the same tax deduction as other savers, as they also will be able to claim retirement annuity deductions against pensionable and or retirement funding income within the prescribed limits. In addition, the minimum fund balance that was required for annuitization for a retirement annuity will also increase from 75,000 to 247,500. Now, if we look at the income tax impact on pension funds for the member and for the employer, and we'll see now when we look at provident funds, they are virtually the same. The pension fund, the employer may deduct a contribution to their pension fund up to 27.5, as we discussed, of taxable income or gross remuneration, whichever is the higher, or the 27.5% limit applies to the aggregate of all their funds, pension, provident, and RA, and they will have this overall deductible limit of 350,000 per annum. The 350 cap includes the cost of any risk cover, such as life cover, disability cover, or any other cover that they've added to the fund. Contributions over the annual limit may be rolled over to future years, but will be subject to the limits applicable in these years. The employer may deduct unlimited contributions to the employer's or employees' pension fund. The contributions made by the employer will, however, be taxed as a fringe benefit in the hands of the employee. Now, if we look at the withdrawal benefits on a pension fund, the full amount may be taken as a lump sum that's at withdrawal, not of a withdrawal lump sum tax. This may change at a future date, but no law has yet been passed to this effect. Then at retirement, only up to 1/3 may be taken as a cash lump sum, net of tax. At least 2/3 must be used to repurchase a compulsory annuity. A compulsory annuitization applies to fund balances above 247,500. If it's less, then it will pay out as a cash amount. Transfers, you can transfer tax-free to a pension preservation, or to a retirement annuity fund. If we look at the provident fund, we see for the member it is similar to the pension fund, and the employer's arrangement here is also similar to the pension fund. So I'm not going to discuss this in detail. We have already discussed that. On withdrawal, that's now when you early withdraw, full amount may be taken as a lump sum, net of withdrawal lump sum tax. This may change at a future date, but no laws have yet been passed to this effect. At retirement, the full amount may be taken as a cash lump sum, subject to retirement lump sum tax, which is the 500,000. No compulsory annuitization. So it's up to the member what he do with the money and whether he wants to invest it in a monthly pension. Transfers can be done tax-free to a pension or provident fund, to a pension or provident preservation fund, or to a retirement annuity fund. Right, if we look at the retirement annuity fund, for the member, the employee may deduct contributions to their pension fund or the retirement annuity fund up to 27.5% of taxable income of gross remuneration, whichever is the higher of the tax. The 27.5% limit applies to the aggregate contribution to all funds, pension, provident, and retirement annuity. The overall tax deductible limit is 350,000 per annum, as for the other funds. Contributions over this limit may be rolled over to future years, but will be subject to limits applicable to those years. So this is very similar to the pension and the provident, and that's why they've done this, is to align all these funds. For the employer may deduct unlimited contributions to the employee's retirement fund. Contributions made by the employer will ever be taxed as a fringe benefit. Right, on withdrawal, it will still not be possible to withdraw from a retirement annuity other than an early retirement due to ill health or on formal immigration, or if the fund balance is less than 7,000. In those circumstances, the full amount may be taken as a cash lump sum, net of withdrawal of lump sum tax. At retirement, again, up to 1/3 may be taken as a lump sum. It's treated exactly the same as a pension fund, subject to retirement lump sum tax. At least 2/3 must be used to purchase a compulsory annuity. The compulsory annuitization applies to fund balances above 247,500. So that's the same across all three funds. transfers to another retirement annuity fund only. So you can't transfer it to a pension or a provident fund, only to another retirement annuity fund. Right, how will legislative changes affect employers? Companies that make employer contributions can deal with these changes in two ways. Number one, keep the employer contribution. They can maintain the employer contribution, levy the fringe benefit tax, and show an increase on an employee's retirement fund contribution, thereby reducing the employee's tax deduction. This will create some additional payroll administration process for the fringe benefit tax. These are payroll issues. The employer must simply fill in the required fields, on the system. The 27.5% contribution limit must be linked to the remuneration and not to the pensionable salary. Secondly, provide for employee-only contributions. They can also convert the employer contributions into an employee contribution. To do so, they would add the value of the employer contribution to the employee's salary and increase the value of the employee's contribution accordingly. With effect from the 2017 tax year, for example, from 1 March of 2016, contributions by an employer to a pension, provident, or retirement annuity fund for the benefit of an employee may be then treated as a fringe benefit. Applying the rules required categorization of retirement funds into either defined benefit or defined contribution funds. We'll discuss this also. With components of each type. In practice, all retirement annuity funds are purely defined contribution funds. A defined contribution fund or component is defined as one in which the value of a member's interest is made up of his and the employer's contributions made in terms of the fund rules at the fund rate. Any transfers in or conversions from an amalgamation with other funds and the return earned on this period. A defined benefit fund is any other fund or component of a fund. We'll discuss this also a bit more in detail later. Right, the tax implication on benefit payments. Right, a member may receive various types of benefits from a retirement fund, and the tax applicable depends on the event that gives rise to this claim. Tax is applicable as soon as a member takes a cash benefit from a retirement fund. Members can always avoid tax by transferring the accumulated saving in their retirement fund to another approved fund. And this is a suggestion I would make, is to rather transfer your funds to another fund when you resign and not to take that money, because the money was in the first place put aside for retirement purposes and not for spending purposes. Right, resignation or dismissal. From the 22-23 tax year, a member who takes a lump sum benefit from the retirement fund on resignation or dismissal will be taxed according to the following table. Now, this is the current table that's in place. We'll see if they're going to increase this, but currently it's still 25,000, which is tax-free. And then it works on a sliding scale, 25,001 to 660. So any amount above, let's say you've got 600,000, then you deduct the 25,000, and that amount is then taxed at 18%. If the amount from your pension fund lump sum is above 660,000 but less than 990, then there's a fixed tax of 114,300 you'll have to pay, and whatever amount exceed, let's say you've got 980,000, which is just below that threshold, then whatever is above 660 will be taxed at additional 27%. So that additional amount of 27% will then be added to the 114,300. If the lump sum amount you get out is above 990,001 or 990,000, then the fixed tax rate is 203,400, and whatever exceeds, let's say you got 1.5 million, That other 510,000, which exceeds the 990, will then be taxed with a 36% tax rate. So that amount plus the 203,400 will then be added together to get to the amount of tax that you need to pay. Right, that's in the case of withdrawal or resignation. In the case where you are now retiring from the fund, then the calculation will work differently. So Provident Fund members, in addition to the 25,000 tax-free lump sum to which the member is entitled on his withdrawal, he will also not be taxed on the member contribution he have paid into the fund. As per the previous section, member contributions to a Provident Fund are not tax deductible, so the member receives these back free of tax when he exits the fund. Now, the calculation at either death, retirement, and or retrenchment for the 22-23 tax year, a member who receives a retirement lump sum benefit from a retirement fund on death or retirement will be taxed according to the following table. So at retirement, which is 55 years and older, and or retrenchment and or death, there will be a 500,000 that will be tax-free at a 0% tax rate, and anything above 500,000 would be taxed at 18%, anything above 700,000 at 27%, and everything above $1,050,000 at 36%. So you'll see that the table for retirement is much more lenient than the table at resignation. And the reason for that being that the tax office actually want to discourage people from taking their money. That's why there's a heavy tax burden on those that take their money early, because the money was actually earmarked for retirement and not for spending on luxury goods and cars and stuff like that. Right, let's have a look at the Constitution of the Republic of South Africa 108 of 1996 as applicable to pension funds. The South African Constitution refers in various sections to the constitutional rights of individuals. The following sections are relevant to retirement funds. Section 9. The right not to be discriminated against. A retirement fund may not unfairly discriminate directly or indirectly against its members on any of the grounds listed in the Bill of Rights, for example, race, gender, sex, marital status, and or sexual orientation. Right, so a retirement fund cannot include in its rules or practices any unfairly discriminatory benefits. A different retirement age for men and for women, for example, would be viewed as unfair discrimination in terms of the Constitution. So both need to retire at the same age or allowed to be retired at the same age. Section 18, the rights of freedom of association. While this right may be enforced outside of a retirement fund, for example, to belong to a trade union, the requirements that members of a retirement fund may be compulsory for eligible employees in order to achieve tax recognition cannot be frustrated or be subjected to an individual's right to freedom of association. Section 23, the right to fair labor practices. Since the rules of a retirement fund forms part of the terms and conditions of an employee's contract of employment, they must be considered in the context of employment relationships between employer and the members of the fund. Right, Section 25 of the Constitution, the right not to be arbitrarily deprived of property. The pension fund adjudicator has held that property in the context include a member's right to an interest in a pension fund. For example, a benefit payable by such a fund. Thus, it would be unconstitutional for the trustees to withhold payment of a benefit to a member or his beneficiary on unreasonable or arbitrary grounds. Section 32, the right to information. As a result of this section, members have a right to information regarding their benefits in the fund. Importantly, trustees have a legal duty to ensure that adequate and appropriate information is communicated to the fund members in Section 7D of the Pension Fund Act and Pension Fund 86 and 90. Section 33, the right to just administrative action. Members of a retirement fund have the right to insist that decisions made by the trustees are lawful, reasonable, and procedurally fair. If a member's rights have been adversely affected by a decision of the trustees, he also has the right to be given written reasons for such a decision that was made. Right, the basic condition of Employment Act of 1997. In terms of Section 29 of the Act, when an employee commences employment, an employer must supply the employee with, amongst other things, the following particulars in writing. The first one is Section P, a list of any documents that form part of the contract of employment indicating a place of reasonably accessible to the employee where a copy of each may be obtained. In terms of Section 29.2, when any matter listed in subsection 1 changes, the written particulars must be revised to reflect the change, and the employee must be supplied with a copy of the document reflecting the change. In terms of Section 29.3, if an employee is not able to understand the written particulars, any aspects of the contract of employment, the employer must ensure that they are explained to the employee in a language and in a manner that the employee is able to understand. Compensation of Occupational Injuries and Disease Act 93 and Workmen's Compensation Act of 1941 provides for compulsory workers' compensation for all employees who qualified, paid for the employee's contributions to a central fund, providing employees with compensation against accidents arising out of and in the course of employment and occupational diseases. Section 22, no compensation is payable in terms of the Act unless A, the accident result in serious disablement, or the employee dies in consequence of the accident, leaving a dependent wholly financially dependent upon him or her. The Labour Relations Act of 1995, Section 197 and 197A of the Labour Relations Act relates specifically to the takeover of a business as a going concern, or the taking over of a business in liquidation or as a compromise with the creditors to avoid liquidation. Clause 4 of this section states that a transfer to the new employer retirement fund can be negotiated as a transfer in terms of Section 14 of the Pension Funds Act. In the absence of such an agreed negotiation, transferring members will automatically become entitled to a benefit from that fund. The Taxation Amendment Act of 2009, which deals with beneficiary funds, pension to provident fund transfers, arrear maintenance, surplus paid to employers, unified taxation of withdrawal of retirement benefits, the Formula B, which is repealed, divorce awards in the case of a divorce, post-retirement medical pre-funding, and estate duty in the respect of spouses. Right, the Employment Equity Act of 1998, in terms of Section 2, the purpose of the Employment Equity Act is to achieve equity in the workplace by promoting equal opportunity and fair treatment in employment through the elimination of unfair discrimination and the implementation of affirmative action measures to redress the disadvantages in employment experienced by designated groups to ensure their equitable representation in all occupational categories and levels in the workplace. Then let's look at the Promotion of Equality and Prevention of Unfair Discrimination Act 2000 regarding insurance services. A, unfairly refusing one or more of the prohibited grounds to provide or to make available an insurance policy to any person. B, the unfair discrimination in the provision of benefits, facilities, and service related to insurance. And C, unfairly disadvantaging a person or persons, including unfairly and unreasonably refusing to grant services to a person solely on the basis of HIV/AIDS status. As far as pensions is concerned, A, unfairly excluding any person from membership of a retirement fund or from receiving any benefits from the fund on one or more of the prohibited grounds, and B, unfairly discriminating against members or beneficiaries of a retirement fund. The Financial Advisory Intermediary Services Act or FASE Act of 2002. Here we're going to look at general and specific duties. General duties, the FSP must render financial services honestly, fairly, and with due skill, care, and diligence, and in the interest of clients and the integrity of the financial services industry. The specific duties of the representative is representation and information must be in plain language, factually correct, and avoiding uncertainty and not be misleading. Information must be adequate and appropriate for a particular financial service and take into account the client's level of knowledge. Information must be provided timeously to ensure that the client has sufficient time to make an informed decision. Information must be provided orally and confirmed in writing if so required by the client. The specific duties continue. Written information must be in a clear and readable print size, spacing, and format. Information must be reflected in specific monetary terms regarding all amounts, sums, values, charges, fees, remuneration, or monetary obligation mentioned therein, or if not reasonably predeterminable, it is basis of calculation must be adequately described. Information need not be repeated for the same client unless material changes have occurred. Like if we look at this in practice, the FASE Act is a critical piece of legislation regulating the behavior of who? Not the client, but the financial planner. Whilst the full investigation of FASE falls outside the ambit of this course, it is essential that all planners are aware of the objectives of FASE. And that is, number one, to protect the client who use financial services and products, to protect the financial services industry, and also to protect intermediaries. Right, what is the role of regulators in the retirement fund industry environment? We have the Financial Service Conduct Authority, who's represented by the Commissioner, the South African Revenue Services or SARS, the Pension Fund Adjudicator, and then we've got legislators. So let's look at the Financial Services Conduct Authority or the Commissioner. The FSCA monitors and regulates the retirement fund industry to ensure members' best interests are always served. Their powers of regulation include both funds themselves and the service providers of these funds. The FSCA requires that funds make certain submissions within stipulated deadline dates, financial statement, rules of amendments, section 14s, etc., and that service providers, administrators, and consultants comply with certain requirements as set in the Act, both before they can provide services and on an ongoing basis to ensure their ongoing ability to provide services. The FSCA is tasked with ensuring that industry operates in compliance with the legislation that is governing it. SARS, or the South African Revenue Service, a fund enjoys tax deductibility of contributions because of its approved status with SARS. The fund rules and any amendments are approved by SARS, giving the employer the right to claim contribution as a tax deduction. And this tax deduction makes retirement funds attractive to both employers and members. In return for the tax approval, SARS, through the Income Tax Act, sets out several requirements with which funds must comply. The Pension Fund Adjudicator. A pension fund adjudicator was established to investigate and make decisions on complaints relating to administration of retirement funds, the investment of the assets, or the application of their rules. The member or former members of a retirement fund, a beneficiary or former beneficiary of a fund, an employer who participate in a fund, or the board of directors of a fund, or a member of the board can make the complaint. The pension fund adjudicator is thus the office tasked with resolving member complaints. It is very important as an administrator to acknowledge when you have received a valid complaint from a member or a former member and ensure that you respond to that complaint timeously, because if you don't, they're going to go to the pension fund adjudicator. Once a complaint is received, a fund has 30 days in which to respond. Failing to receive a satisfactory response within this time would give the member, therefore, the right to raise the complaint, with the adjudicator's office. So rather deal with the complaint at your business level before the client, go to the adjudicator. Right, and then lastly, the legislators, it is essential to appreciate the FSCA, SARS, or the adjudicator do not have law-making powers. Their job is simply to ensure compliance with the law and see that it is in place. Right, taxation of retirement fund contributions. Before March 2016, the different types of retirement funds, pension fund, provident, and retirement annuities, each had their own set of tax-deductible applicable. Provident fund contributions had no tax benefits. However, from the 1st of March, all types of retirement fund benefits are treated the same for tax purposes. With effect from 1 March 2016, contributions to a pension, provident, or retirement annuity fund, or even a combination of all three, qualify for the deduction of 27.5, as discussed earlier, of a member's taxable income up to a maximum of 350,000 per tax year. The limit is applied to all contributions made to the various funds for tax purposes. 27.5 include member and employer contributions. However, if the maximum is exceeded in any one year, the excess can roll over the excess to the next year, as we mentioned previously. Any carried forward excess contributions will be used to decrease the tax payable when a cash lump sum is paid out. So you can deduct it at that point again. Right, let's take an example. Taxable income, which includes salary and director's fees, rental income, etc. Let's say it is 50,000 per month. And you contribute 2,500 to an RA and you contribute 5,000 to a provident fund each month. So that's now 7,500 in total. It means that your total retirement contribution for the year are 2,500 times 12 plus 5,000 times 12, which is 30,000 plus 60. That adds up to a total yearly contribution of 90,000. The total annual taxable before deduction is 600,000, which is 50,000. If we look at these per month income times 12, that gives us 600,000. It means that you can claim a tax deduction of up to 165,000, which is 27.5% of the 600,000. He's only contributed 90,000. You are limited to the total of your actual, you can't claim the 160, you can only claim your actual amount, which in this case amounted to the 90,000, can be deducted from your taxable income for the year. Therefore, your taxable income for that year was 600,000. There's a 90,000 deduction allowed, which is 600,000 minus 90. So your taxable income now becomes 510,000. So the new tax table after deductions, you will use the 510 to calculate your tax liability. And that will obviously amount to a reduction in tax that you need to pay. Right, if we look at the taxation of retirement fund benefits, on a retirement from a pension fund, pension preservation fund, or retirement annuity, I think we've discussed this now numerous times, a member is allowed to a maximum of 1/3 commutation lump sum to the fund credit unless the entire value of the fund does not exceed the 247,500. in which case the member may take the full amount. If receiving an income from a living annuity, the member is allowed to commute the amount as a lump sum once the remaining assets are below 50,000. Retirement from a provident fund or a provident preservation fund, members have the option to opt for a cash lump sum unless the rules of such a fund provide for the payment of an annuity on a member's retirement. Right, we've looked earlier at these tables at retirement, retention, death, and disability. We make use of the 500,000 table. On withdrawals, resignation, or dismissal, we make use of the 25,000 table to calculate our tax liability on withdrawals and or early retirement benefits from the fund. This concludes our session of the tax and the tax impact on retirement funds. The next session that we will cover will be Unit 4. Here we will discuss financing of retirement funds. So thank you very much for listening to this session. I know it's complicated, tax is not easy, but I think we try to explain it in an easy as possible manner. Thank you very much for attending. We see you then in Unit 4, financing of retirement funds. Thank you.